Though each company may call it by different names, and there may be some variations in coverage and endorsements, there are fundamentally three types of life insurance: term, whole life, and flexible life. Which product is best is dependent on the need of the clients and usually determined in the discovery conversation. For an agent to be most effective in making recommendations for their clients, they must first understand the policy they represent. Let's break down the different life policies and see how it works. Term life insurance is a policy that is most economical, and rates are generally based on the age, gender, tobacco or non-tobacco, and health of the applicants. The word term refers to how long a policy rate would be locked in. For example, a 5-year term would mean the rate being offered is guaranteed for 5 years. After the 5 years, the rate can and most likely would change in an upward trend. The higher the term, the more expensive the rate would be, as the insurer has to guarantee the rates for a longer period of time. Purchasing term life insurance is like purchasing an auto insurance policy. Coverage is provided while payment is made. If payment stops, outside of a short grace period, coverage will also stop. Term insurance are usually considered for two reasons: short-term need. For example, some people would consider term insurance when they are borrowing money and want to make sure the loan is covered. Coverage may be purchased for the duration of the loan. Cost efficiency. The client is on a budget and cannot afford other plans that may be more costly. There are also those who prefer buying the term policy because they feel money saved can go toward other investment strategies. When purchasing a term insurance, there are also some features that should be considered. Is the term policy renewable? What this means is at the end of the term, will the client be able to continue the policy if they choose to continue payment, even at a higher cost? Some insurance carriers do not allow an automatic renewal, but will require a new health exam to qualify. This may be a disadvantage if the client's health is in question. The reality is that as we age, our health can change for the worst. We want to make sure that we have choices and not be put in a situation when we need coverage. The most is when we cannot obtain it. On the other hand, if the client is in good health, an opportunity to retake an exam may allow them to get better ratings. A good policy should provide this option, and an insurance carrier that offers this will have a competitive advantage. Is the rate a guaranteed fixed rate? Many term policies will offer a fixed rate for a short period of time, then a range of guaranteed rate rather than a true long-term fixed rate. An example, a 10-year term may have a rate of $20 per month for the first 2 years, then a rate of $20 to $30 for the next 8 years. Insurance carriers will do this to hedge themselves against unexpected higher mortality rates. This is not necessarily a bad thing. However, if the client purchased a term policy for economic reasons, they should clearly understand the policy and not be surprised at a later date. On the other hand, there are many insurance carriers that will offer a true fixed cost, allowing the client to be prepared and able to work within their budget. Does a term policy offer a dividend? These policies are rare these days, but it does exist. If the client can purchase a comparable policy but one offers a dividend while the other one does not, it is a no-brainer that the dividend-paying policy should be considered. When will the term policy end? Many people mistake end of term as end of insurance, or a worse misunderstanding is that the policy is paid up at the end of the term. Remember, the end of the term merely indicates at the end of the guaranteed rate period. That said, all term policy will cancel at a certain age with no options for renewal. This age can vary by insurance carriers, usually at about 80 and up. With the statistic of an average male living to the age of 83 and female living to the age of 93, this limitation is a real concern. If there is a potential need for coverage beyond the limit, a different type of policy should be considered. The longevity, stability, and rating of the insurance carrier. It is a guarantee that life insurance will pay out at some point. Will the insurance carrier be around to make good on their promise to pay? Pricing is important, but if the client chooses a company that is not financially stable, have adequate rating, they may be bankrupted and all the premium paid may be lost. Worst is if this happens when the client is older and in poor health. They may not be able to purchase life insurance, or if they do, it will be at a premium cost. Traditional term insurance is considered an increasing term, meaning as a person increases in age, keeping coverage the same, the policy premium tends to increase with time. There are also other types of term policies such as decreasing term, return of premium, and an employer-sponsored term policy. Decreasing term is a policy where coverage decreases with time. Just like the traditional term policy, qualification is based on age, gender, health, and tobacco status. Premium for this type of policy will remain the same over its term, but coverage will decrease and terminate at the end of the term. This type of policy is designed for short-term needs, and the customer requires less coverage as time goes on. An example would be a variation of loan coverage, such as personal loan, auto loans, but most popular with mortgage loans, and is called mortgage life policy. Many mortgage life policy will base its coverage on the term of the mortgage loan and its interest rate. These type of policy offers consistency in premium, but have the disadvantage of the loss of insurance coverage. When choosing this type of policy, the customer may want to consider whether they will trade up their homes in the future or still need life insurance at the end of the term. Premium will increase with age and health profiles, so careful consideration should be made when purchasing this type of policy because qualification and cost can be challenging in the later years. This type of policy is attractive for those who want coverage but also want the ability to recoup premium paid if they did not pass away during the term of their policy. This type of term tends to be more expensive, but assures the customer that if they remain alive, they will be able to take back a certain amount of premium that was paid into the policy. The amount of premium returned depends on the contract. Some companies will offer 100% of premium returned, while others will offer a portion minus certain expenses. All qualification requirements are similar to that of the other term policies. Many employers will offer term life policies, otherwise known as group life insurance, as an incentive for their employees. These type of plans does not require health qualification for the basic coverage, but could be more costly to the employer. The employer does have a choice of paying for the total cost or co-pay with the employee. An advantage of these types of plan is the employee may be able to have coverage at minimal cost because the employer helps pay for the premium. In addition, if the customer have health challenges, this may be a good way for them to get coverage, though there may be some limit to what is available to them. The other disadvantage is should an employee leave employment, it is most often that they cannot take the coverage with them or have to pay a higher cost and meet qualification in order to obtain coverage. Permanent life policies, otherwise known as cash value policies, offer a product that is fixed in price, have long-term coverage, and the potential of having the policy paid off after a certain period of time. Many agents compare the product as owning versus renting. To describe it in a more technical term, permanent policies are charged at a higher than mortality rate and expense rates, with the excess being invested to gain a rate of return that will help offset the higher cost of mortality in the future. People consider these types of policy when there is a long-term or even lifetime need. There are two types of cash value policies, whole life and flexible or sometimes known as universal life, which includes variable products that have active participation in the market and fixed products that have a guaranteed rate of return. Before diving into the difference between these products, let's first get an understanding of cash value. As indicated, a permanent policy is billed at a higher rate than what is normally cost to cover for mortality, expenses, commission, and profit margin. This extra premium goes toward a cash value account and is invested by the insurer. Depending on the performance and the investment strategy, the account can have accumulated interest that is added to the cash value. Whole life and fixed flexible life tend to have a minimum guaranteed rate of return, while variable or index type of flexible life may have variation of returns depending on the investment strategy and market performance. In the beginning years, after subtracting the life insurance costs, these cash values can be minimal. However, the longer the client has the policy, the more the cash value will accumulate, and with time, the cash value can be substantial. Many utilize cash value as a living benefit that can be withdrawn when the need for life insurance is decreased or no longer needed, though borrowing against the policy is also a common practice for many clients. In the earlier years, when the life insurance is still needed, people may borrow against life policies for down payment for a home, pay for children's education, or pay down higher interest loans. Depending on how long the client have had the policy and how much cash value has accumulated, the client may need to pay back and the policy will continue to sustain with regular premium payment. Keep in mind, the amount withdrawn and any interest accrued will be deducted from the policy prior to the payout of the death benefit. On the other hand, when the life policy need is ceased or decreased, the client may choose to withdraw the cash value, which can have an immediate decrease in the death benefit but prevent the interest charges that would happen if a loan is taken out. Not all cash value can be withdrawn from a permanent policy. For example, borrowing against cash value is the only option on a whole life product. The other precaution is that if there is a gain over the total premium payment, a withdrawal from a life policy can result in taxation. Withdrawal of cash value from a life policy can be utilized to supplement retirement fund, pay off mortgages, recreational activities, just to name a few. Speaking of taxation, cash value in a life policy accumulates tax deferred, and as you can see, depending on how it is utilized, it can also be tax-free to the client when it is withdrawn. We speak a lot about cash value as it is a common feature for a permanent policy. However, outside of cash value, some whole life policies will also offer dividends, which represents a portion of the insurance company's profit that are paid to the policyholders. In order to help your clients and be able to compare against your competitor, it is important to understand the details of these policies, so let's dive right in. Whole life policy, known as traditional permanent life policy, offers a guaranteed fixed premium for life, with guaranteed rate of return and cash value accumulation. This policy is attractive for those needing or wanting life insurance long-term, as premium will not increase with age, making it affordable in later years, though the cost is higher than a term policy in the earlier years. Whole life policy offers a guaranteed rate of return on their cash value, but depending on the performance of the company, the insurer may pay higher than the guaranteed rates. An illustration showing these performances are required of insurance carriers and would be prudent for the client to study this carefully before making their purchase decision. When making comparison, it is important to understand that it is nice to have high guaranteed rate of return. However, depends on the mortality rate, fees, and expenses. The cost may deter the policy from having a real value in their account, and you may find a company with lower guaranteed rate of return with still higher cash value due to their ability to effectively manage the loss ratio and expenses. The best way to figure this out is to take the illustration from the comparing insurers and look at it side by side. It is very much in black and white as to the cash value accumulated through time. I would compare both the guaranteed and the non-guaranteed illustration of their performance. Even for those who don't care about cash value and only purchase the products for long-term coverage, it is still important to understand that the cash value can affect the policy's longevity and possibility of having the policy paid up in the long run. Dividends are considered as a return of premium and is a portion of the company's profits that are paid to a policyholder. Dividends received are treated as distribution from the contract and are taxed similar to other types of distributions, which means they are generally income tax-free until the total premium paid is reduced to zero by this distribution. Once the distribution becomes higher than the total premium paid, dividend distributions can be income taxable. Distributions of dividends can be taken in several ways: cash, or nowadays direct deposit into a person's account on a monthly, quarterly, or annual basis. It can be utilized to offset premium billed on the life policy, reducing the cost of the policy, purchase additional insurance, or sometimes purchase as a paid-up policy, or just accumulated in the life policy account. When choosing the accumulated option, the insurance carrier may offer an interest on any principal in the account. Of course, any interest earned will be taxable. Which option the client chooses will be dependent on their need and financial strategies. For example, if the life insurance needs is more important, choosing to have the dividend may be the better option. If the client feels that life insurance needs will decrease in the future, they may choose the cash or accumulated option and utilize that money for their current lifestyle or savings for their future. Or if the client's on a budget and wants to minimize expenses as much as possible, having premium deductions would be a more prudent decision. This is a great feature in a whole life policy that is not mentioned often, as many insurance professionals shy away from talking about this feature. When clearly understood, premium offset is an attractive option in a life policy. When a whole life policy is enforced for a period of time, the dividends may be enough to cover for the premium, thus the clients may not have to pay out of pocket. The important thing to understand is that dividends are not guaranteed, and though it is possible that the dividend may be sufficient to pay for the lifetime of the policy, it is not guaranteed. When discussing this feature, it is important that the insurance professional help the client clearly understand that premium offset is a potential and can change with dividend payout. Though some whole life policies may have its premium offset, some clients prefer knowing that they can get a policy guaranteed to be paid up someday. A whole life limited pay is the answer to this. All the features of the product is exactly the same as a whole life policy, with guaranteed rate of return, guaranteed fixed premium, cash value, dividend potential, and with one difference: it is guaranteed to be paid off after a specific period of time. Depending on what is offered by the insurer, client may be able to choose from a variety of options like 10, 15, or 20-year pay. What this means is after that specific amount of years, the policy will be completely paid off and the client will no longer have to make payments. Dividends will continue to be paid and cash value will continue to increase depending on the company's performance. Term product costs will increase with age, and the whole life has a guarantee that premium will not increase. The cost can be high and the rule for payment can be very rigid. Most whole life policies, unless the premium is offset or is a limited pay policy, if a person stops making payment for any reason, they may lose the policy, especially in the earlier years. Universal life is a compromise between a term and a whole life policy, where long-term premium has the potential of being fixed. Just like the whole life policy, higher premiums are collected in the earlier years, earn a rate of return, accumulate in cash value, and offset the higher mortality costs in the later years. The difference between a whole life and a universal life policy is the flexibility that the universal life policy offers. Though an agent can illustrate a premium that will provide coverage for a flexible life policy lasting to a certain age, the client can choose to vary this payment after a specific time period. There's always a minimum payment required to cover for the expenses and mortality cost, but the client will have the right to decide how much or how little they pay over the life of the policy. Of course, paying only the minimal amount would make the policy perform like a term policy product, and premium can increase over the long run. Or in the worst case scenario, the policy can be terminated for insufficient payments. Let's take an example. The premium for a flexible life policy for a 35-year-old male may be $100 a month. The plan may require the client to make a payment for 2 years before they can vary premium payment. This will mean that the client can pay $100 or more over the next 2 years, but cannot decrease this payment until after the 2 years anniversary of the effective date. Once the 2 years is up, the insured can choose to pay more, less, or stop payment if need be. This allows the insured to have the flexibility to vary payment to adjust to life situation as necessary. Of course, they always have to be conscious of the fact that variations will affect the longevity of the policy, cash value, and coverage. Other features of a flexible life policy is how cash value can be utilized. In a whole life policy, the only option to access cash value is to borrow against the life policy or cash out and terminate it. A flexible life policy, on the other hand, allows the client to either withdraw or borrow against the policy. If they choose to borrow against the policy, the death benefit is preserved, but the amount that was borrowed will be charged interest until it is paid back. A client may choose this option if they have a long-term need for the purchase amount of the policy and feel that they can put back the borrowed amount in the short term. They may also choose this option if they have gained a good amount of return over the premium payment and may have high tax liability if they withdraw on the cash value. As a note, if the return on the cash value is high, even if interest is charged, the policy can continue to have gains, and even if the client did not pay back the borrowed cash value, they may sustain the policy in the long run. So let's take a look at an example. A client has $100,000 in their cash value. They withdraw $50,000 at 3% loan charge. The policy has a 5% return on the cash value. In this scenario, even though the client borrowed some of the money, they still net out a 2% gain on their cash value, and the policy most likely will last without being affected, and the cash value also have a chance to continue to increase on its cash value. How is this possible? Because when the client borrows the cash value, technically the borrowed amount is loaned to the client by the insurer. The cash value is in the policy, remaining intact and continue to earn interest. Though the client can no longer access that cash value and interest that was already taken, they continue to earn interest on the total cash value amount, not just on the balance of what was left over after the borrowed amount is taken. Thus, the growth of the cash value still continues. Of course, even if the interest charge on the loan is higher than what is being paid in the cash value, the net out effect of what is being charged on the loan can be a lot less than what appears to be. For example, in this same scenario, if the loan interest is 5% and the cash value is 3%, the true cost of the loan is really 2% once the offset is taken into consideration. An important note is if the client does not pay back the loan and is unable to increase the premium to maintain the life of the policy, tax consequences may occur if the policy is terminated and the cash value has gains over the premium paid. Now, let's take a look at what happens if the client chooses to withdraw cash value instead of the borrowing option. To start, the life coverage will immediately decrease by the withdrawal amount. If they later want to increase coverage back to their original face amount, they may have to re-qualify by going through a new underwriting process. There are also tax consequences if the cash value has more gain than the premium that was paid into the policy. A client may choose this option if the need for life insurance is less over the long run, won't be able to pay the loan back if necessary, or just want to simplify the process of assessing their cash value. Choosing to withdraw or borrow is a personal choice, but understanding the plus and minus of each of these options is prudent in tax planning and maintaining the policy. In a universal life policy, there are also two options in terms of cash value and coverage. A client can choose to have original coverage amount, or they can have cash value added to the coverage amount and have the policy increase with time without having to go through underwriting. Choosing the option to have the cash value added to the coverage amount does allow the client to increase coverage to keep up with potential higher insurance needs, assessing the cash value without affecting the face amount of the policy, but does require higher premium contributions in most cases. What is most attractive about a flexible life policy is the ability for the client to choose how their premium contribution can be invested. There are fixed and variable flexible life. Fixed flexible life policy has a guaranteed rate of return, tend to be invested in a more conservative portfolio. The insurer is the driver of these investments, and the client usually have no involvement in the decision of what the account is being invested in. If premium is consistently paid, the policy does not have much fluctuations and the client can enjoy a consistent long-term policy. This type of policy is for someone who needs flexibility in their premium payment, access to cash value, but do not want to deal with any variations in the feature of the policy. A variable flexible life allows the client to get involved with the investment of the cash value. The client can choose from a variety of investment options and can be as conservative or aggressive as they want. The insurer usually have a portfolio that the client can choose from. There will be no guaranteed rate of return and the client is responsible for the growth of their cash value. If they choose a portfolio that does not perform well, they may need to increase their premium payment to sustain the life of the policy or can lose coverage. This is a good option for those who like to see their money invested and understand the variations and its effect when participating in the market. There is also a blend of market participation and having a guarantee features, which are flexible index life policies. These policies allow the client to have participation in the market to capture the potential higher gain, usually on the index type accounts, but have a guarantee of life insurance coverage regardless of market fluctuation. The cash value is not guaranteed, but at least the client will have the peace of mind that their life insurance needs are covered. Of course, the premium have to be consistently paid. Additional contribution can be required, especially when the market is on the downside. Regardless of which of the features are attractive to the client, flexible or universal life is the right choice for those who want to be more in control of how they want their life policy to perform. Even though life insurance is not designed to be an investment vehicle and protecting loved ones is the focus, understanding and choosing the right life products can be instrumental in both legacy and financial protection.